I mean, the answer basically is that I've given you the answer with precious metals. Okay. I've also given you the answer for commodities as a whole. We're not pricing them anymore. It's China. Yeah. Now, behind your question, there is the assumption that if you get higher unemployment, then that reduces demand and therefore prices go down. This is a Keynesian rubbish. It's not true. Because these consumers, how do they earn their money if they're not borrowing it? Well, basically, they are employed producing things. They're no longer producing things. So what you see, well, the banking system is sort of okay. I mean, I'm looking at the American banking system. We'll concentrate on that because that's the most important one. I mean, basically, they haven't really been lending to, if you like, non-financial private sector borrowers that much. Their lending in the private sector has been rarely angled at financial markets and consumers. Now, I mean, so really what they're doing is they're promoting asset inflation and they're promoting consumer-driven price inflation. So, there's been no way that there's been an increase in credit aimed at production. I think this is terribly important to understand. So the idea that inflation is going to go away, you can forget it. And on top of that, we've got Trump's tariffs. Now, the apologists for President Trump say, well, look, everybody was saying that it's inflationary, and where's the inflation? But the fact of the matter is that it takes time for the consequences of higher tariffs to work through. And my goodness, they will work through. So that's, so in general, I don't think the problem is so much in the banking system. There is no doubt, however, that so long as rates are, if you like, being kept up, that zombie corporations who, took out debt needlessly, when interest rates were zero bound, are now having to refinance because this is 5 years later, and a lot of refinancing is ahead, and that is going to hurt these businesses hugely. And I think there's potentially some huge liquidity problems, if you like, in the industrial sector. So that, I think, is the overall situation. But of course, the problem as far as banks are concerned is that having puffed up the financial bubble, particularly equities, that bubble will pop. And when it pops, then there's going to be trouble. So at the moment, banks are not in trouble, but when it does pop, they will be in trouble. And the Fed will do everything it can to keep the bubble going. It will try and, it'll rescue anything, basically, which is large. I mean, smaller and medium-sized businesses haven't got a hope in this environment. But the larger ones will be rescued. And of course, the way they do that is by debasing the dollar. And it's just smelling the air, really, what gold is doing, if you like. That's really why gold not only has risen so sharply in recent months, but is likely to continue to do so.
Many corporations borrowed aggressively during the era of zero interest rates. Now, as refinancing deadlines arrive, these zombie firms face borrowing costs they cannot sustain. This puts enormous pressure on industrial liquidity and threatens large pockets of the real economy. If equity markets break, banks will feel the shock next. The Federal Reserve will almost certainly intervene to rescue major institutions, but smaller businesses will be left exposed. These rescue operations will rely on one tool: expanding money supply and weakening the dollar. That dynamic is already visible and explains why gold has surged so sharply in recent months.
Well, there's a bit of profit taking, but not hugely. It had got to the point, I think, where the shorts, the establishment shorts, bullion bank trading desks, and so on and so forth, could see that the markets were vulnerable to a shakeout. So they shook it out. And I mean, amongst my Substack subscribers, I know of some who were shaken out, despite me saying, look, for goodness sake, don't trade this because you'll get slaughtered. Just stack. And, I'm glad to say the vast majority of them do that, but one or two of them on the edge have really got caught. And I don't know when they'll get back in because they're thinking like investors. This is not an investment story. This is a protection story. It's not a question of trying to, accumulate wealth. It's a question of protecting wealth. That is the key to understanding really what is going on and and how you should react to what is going on. Protect wealth, and protecting wealth basically means getting into real money and getting out of credit. Just get out of credit as much as you can. The ups and downs in the market then become completely irrelevant. That's the way to look at it. But it was interesting that this shakeout has actually occurred at a time when gold and silver were not overbought at all. Look, if you look at the indicators like mechanical indicators like the relative strength indicators, then it was overbought. But, if you look at actually what was happening in the market, like open interest in these contracts, the open interest was sort of slightly below the average, which tells us that speculative activity is not that great. So the shakeout wasn't going to really shake out an awful lot of stale bulls, or bulls, if you like. That just didn't happen at all. It's interesting that the first sign of metals recovering from this sudden shakeout, you've got people getting back on board quite quickly in COMEX. I mean, the open interest in COMEX yesterday on provisional figures jumped something like, 12, 15,000 contracts. So you can see that there's an awful lot of people thinking, oh, we made a mistake. if you see what I mean. This is not an overbought market. It is a market which has been rising on the establishment being squeezed all of a sudden, because nobody really in the investment management field has actually owns gold or silver. I mean, the level of exposure, just looking at ETFs and making a few assumptions about bullion, level of exposure is about 0.5% of all portfolios. This is not excessive. But the problem in terms of liquidity is that people are beginning to realize that, the performance of gold and silver is knocking the Magnificent Seven tech stocks into a cocked hat. They're in the wrong things. So they're going to have to move out of those stocks into gold and silver, just purely, on demand for performance basis. But the problem there is to increase average exposure by 1%, only 1% in gold, involves the purchase of 25,000 tons. So how does this get resolved? The answer is it only gets resolved at far, far higher prices. Now, that's an investment management analysis. It actually backs up the correct analysis, which is very, very different. And that is, it is the value of fiat currencies coming to a conclusion, an end. We're looking at the end of the fiat currency system, and their values will decline until such time as the central banks who issue these currencies actually take the means to secure the value of these currencies. Now, what that basically means is you've got to tie it to gold. There's no other option. But, if you look at the American situation, they've spent the last 54 years denying that gold is part of the monetary system and that it has been replaced by the dollar. They are all intellectuals, sort of macroeconomic, Keynesian or monetarist intellectuals who actually don't understand economics in the classical sense, which is the only sense that really matters. And so, how does the whole system, if you like, which is based on fallacy, turn round? It's not going to turn around quickly. And of course, the problem is that, when you've got a fiat currency, things are driven by politics. And when they get driven by politics, effectively, central bankers are powerless to take the right action. They're not getting the right advice from all the PhDs they employ. And not only that, but they wouldn't be allowed to take the right actions as by their lords and masters, who, I know all this stuff about central banks being independent, don't believe it. At the end of the day, they are political appointees, and their lords and masters are the politicians. And the politicians basically cannot step in and sort things out. I mean, the only way they do that is basically when their currencies lose all their value. And so what's that mean? It means that, the dollar goes down to zero. It's, there could come a point along there where, there's enough of a mandate from the public for President Trump, if he's still in office, to actually authorize the correct action to fix the value of the dollar to gold, to turn things around. But the man's a spendthrift. He's got to turn around completely. And he's not a person who accepts blame for things easily. He's not a man who says, oh, I got it wrong. We have got to get this right. No, he's a man who basically, like Captain Carpenter in the poem by, I can't remember who it was, an American poet, you just battle on until he's dead. I mean, and so we can begin to sympathize, if you like, with Rudolf Hammerstein, who was the head of the Reichsbank in Germany in the early 1920s. There is no option. There is no option. So we know where this is going. You just got to look and understand. That's where we're going. It's the end of the fiat currency system. The end of the fiat currency system basically tells us that it ends with fiat currencies being completely worthless. It's a process that can be stopped, but I just cannot see that there is the political will, the political mandate, and the intellectual understanding of the advisors to actually stop it. So I assume it's going down to zero until I know otherwise.
Gold's rally is not driven by speculation, but by a deeper recognition that fiat currency is losing credibility. Recent price dips were manufactured shakeouts rather than genuine selling pressure. Open interest data shows investors quickly returning after brief declines. This is not a trader's market. It is a market for preservation. The real story is about escaping credit risk and holding assets that cannot default. Most portfolios still allocate less than 1% to precious metals, meaning large-scale reallocation would require thousands of tons of gold that simply do not exist. Rising prices are the only possible outcome.
Wake up, I think is the answer. I mean, the Silver Institute's sort of estimates of supply and demand have had silver in deficit really for the last, 5 or 6 years. The balance is always made up by drawing down on investment. Now, define investment, well, let's not go there, but you can see that, basically, the supply and demand situation is only balanced by being managed. And it has been managed by China over a long period of time. But as you point out, the silver is now effectively going out of China, and China is trying to put a stop to it. The level of stocks in the Shanghai Futures Exchange are now perilously close to 600 tons, which is seen as the minimum liquidity to back that market. So, it doesn't surprise me at all. Silver, I think, with this squeeze, has the potential to go far, far higher. And also from an investment point of view, horrid word investment, or phrase investment point of view, I think people who feel that they've missed the gold run, as it were, are going to see silver as the cheaper alternative. to getting in. Now, that's just a purely emotional argument, but I think people will adopt that argument. And so if you look at the London vaulting situation, most of the silver held in London vaults is actually ETF silver. So if you get an increase in demand for ETFs, then the liquidity just disappears completely. And this is why the spot market has been at a premium, in other words, in a backwardation, compared with the futures on COMEX. I haven't looked at it this morning. I mean, the backwardation has gone down, but it still persists. So, this tells us there's no silver around. There's no liquidity. And under those circumstances, where is it going to come from? I mean, you can see that industrial users begin to wake up and think, oh my God, we've got to pay a lot more for our silver. Even if we don't pay it, we're not going to let any go. I mean, we just got to hang on to it. So I think that's really driving it. And also the other thing, of course, is if you look at the major refiners, they're very, very busy with gold. I mean, they really are. So silver is almost a sort of, secondary issue as far as they're concerned. And that doesn't help either.
Behind the market turbulence lies a larger structural shift, the slow unraveling of fiat money. Western policymakers have spent decades insisting gold plays no role in modern finance, yet inflation and political constraints have stripped central banks of effective tools. Returning to a gold-backed framework would require admitting decades of policy failure, something political leaders rarely do. Without decisive action, currencies continue eroding until confidence collapses entirely. Historically, these transitions are only reversed when citizens demand reform, but current leadership and intellectual frameworks show little readiness. The trend is toward continued currency devaluation, potentially accelerating in coming years.
I think the first thing I would say is that gold, if you like, leads commodities in terms of their direction. So what we have now, if you look at a basket of metals priced in gold, that basket is now ultra cheap because gold is anticipating the falling purchasing power in the dollar. Okay, so those metals will catch up. That's the first thing I would say. The second thing I would say is that we're so focused on G7, on America, Europe, Britain, Australia, and all the rest of it. We forget that 70% of the world is actually in the Chinese and Russian sphere of influence. Shanghai Cooperation Organization, BRICS, and so on and so forth. And if you look at the Chinese economy, in purchasing power parity terms, it's bigger than America by a long way. So, there is a world out there which is insulated from our problems. China and Russia between them, but particularly China, has for a long time been creating its own markets away from dependency on the West. It's invested in infrastructure, whether it's railways, shipping, ports, so on and so forth. The whole, and also technology. They are way, way ahead of us. There is a world there. We've got two worlds here, actually. We've got our world, which is going to hell in a handcart, and you've got the Chinese-led world, which is on the verge of a new industrial revolution. This is why Africa is growing, sort of 10% per annum, whatever, in terms of its GDP. All that investment is going into Africa. Africa is changing very, very rapidly, and you're talking about over a billion souls in Africa. You've got the partnership between China and India, which is building and building and building. I mean, we're talking 70% of the world's population rapidly industrializing while we go down the plug hole. That is the future, and that is what is going to determine or continue to provide demand for all raw materials. So, this is I think the 20s and into the 30s is going to be the era of commodities. But in addition to that, our currencies are on the verge of a collapse. So what does that do to price? I mean, this could accelerate the collapse quite significantly. And we could find that the fiat currency system is over and done with within a couple of years, maybe even sooner. I don't know. We don't know the timing of this. But we can see the factors which are leading up to it.
Silver's supply deficit has persisted for years, quietly balanced by stockpile withdrawals, especially from China. But inventories are now extremely low, forcing China to restrict outflows. Spot markets increasingly trade at premiums over futures, signaling acute tightness. Industrial users, especially in solar, electronics, and battery manufacturing, are beginning to secure supplies early, driving competition even higher. As investors who missed gold's surge turn to silver as the more affordable alternative, ETF demand threatens to drain remaining vaults. Refiners are overwhelmed with gold orders, delaying silver output further. With no easy source of new supply, prices can only rise.
I mean, the answer basically is, I've given you the answer with precious metals. Okay. I've also given you the answer for commodities as a whole. We're not pricing them anymore. It's China.
There you go.
Yeah. Now, behind your question, there is the assumption that if you get higher unemployment, then that reduces demand and therefore prices go down. This is a Keynesian rubbish. It's not true. Because these consumers, how do they earn their money if they're not borrowing it? Well, basically, they are employed producing things. They're no longer producing things. So what you see is a decline in demand at the same time as there is a decline in supply. So the idea that the whole situation gets rescued by a recession or a slump, and that will ensure that prices don't fall. This is wrong. It's completely wrong. It goes back to Keynes's general theory, where I think very early on, something like page 25 or something, he tried to rubbish something called Say's law, which basically is, I mean, the way he redefined it is that supply creates its own demand. No, that's not quite right. The way to look at it, Say never actually put down his theories into a specific law. It was subsequent economists actually trying to define it in a handy phrase. But the fact of the matter is that if consumers are out of work, then the businesses that provide consumer products equally, I mean, they will have sacked the consumers. They will have reduced their consumption. And mass automation basically means that the consumption, if you like, the consequences of people leaving employment could be even higher in terms of cutting off supply. I mean, this is a very important point to understand. That Say's law actually does apply. It's not a simple across the board everything, if you like, sort of explanation of why supply falls at the same time as demand. I mean, that's not true in many, many cases. When it comes to commodities, demand for commodities, yes, if you get a fall in demand, economic demand generally, then demand for commodities will tend to fall. But as I have said, there's a world out there which is far bigger than us and rapidly industrializing, which will ensure that commodity prices will continue to rise, even without the debasement effect on prices of collapsing fiat currencies. So go back to Say's law, read that one. That's very, very important. And adapt it a bit, okay, for today. But that will, the idea that the fiat currency system is going to be rescued by a recession, I mean, come on, it's just nonsense, complete nonsense.
While Western nations face slowing growth and currency strain, much of the world, including China, Russia, India, and rapidly developing African economies is expanding industrial capacity. Over 70% of humanity now operates within economic blocs increasingly independent of Western financial cycles. China's infrastructure investments and technological production are driving enormous energy and metal demand. This ensures long-term support for commodity prices regardless of Western recessions. The idea that a downturn will fix inflation misunderstands global supply dynamics. With shrinking Western production and expanding Eastern consumption, the 2020s and 2030s are set to become a commodity-driven era.